Well, the Federal Reserve begins its latest open market committee meeting today, and the question of whether to raise rates again or to hold off is at the forefront of the discussion. The banking failures of the last couple of weeks have also shown greater concern of whether the quick rise in rates over the last year have played a part in those failures. Jeremy Siegel, Professor Emeritus of Finance at the Wharton School, joins us right now. Jeremy, great to talk to you again. Thanks for your insight and your time.
Thank you, Dan. Happy to be here.
Thank you. And so what's your feeling right now? Because there's obviously, I think, a little bit more in play than we normally associate with the Fed decision because of all that's going on in the banking sector the last 2 weeks.
I mean, I think the failure of Silicon Valley Bank just changed the narrative really dramatically. You know, beforehand it was hike, 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 only inflation. And now, and you know, Dan, because I've warned that I thought the Fed was over tightening and that an accident was likely to happen. And, you know, I certainly didn't expect it to come right as a bank run that was closed faster than any other bank that I actually remember. But it did. And obviously, you know, there is contagion. We see what's going on with First Republic, and Signature Bank closed. There may be some other fallout, but there's not going to be a general bank run. The Fed will stand behind them. The big problem, of course, is this going to tighten lending standards. Every community bank, which does, as you know, a tremendous amount of mortgage and commercial lending, is going to be looking over its shoulder and say, oh my God, do you have the credit? Am I going to get a regulator looking at me? What's my position? Do I have long-term bonds that also are selling at a discount? You know, one of the fallouts of the inverted term structure and why inversion has preceded every single recession in the last 60 years is precisely something like this. You know, banks borrow short, they lend longer. Now, obviously, Silicon Valley did it in extremum. They should never have been allowed to do that.
Right.
But when you invert the term structure, you can get these sort of accidents.
So there's a lot of question as to how this all kind of played out. What's your view? Because, I mean, as you said, there's a question about the Federal Reserve and maybe even more specifically the San Francisco Fed in terms of overseeing what was going on in that region of the country. There is obviously the component of having 0% rates for such a long period of time and the actions that were taken that kind of, you know, in that bond market that kind of led to this. Is it a case where you can kind of point to one or two things, or is it kind of a combination of all of these components?
Well, you know what I learned, and I didn't know this until I talked to some, you know, banking experts since SVB, is that the Fed, you know, these famous stress tests that were initiated after the great financial crisis were done on credit quality, and they only were done on interest rates up to 2%. And obviously went way beyond that, and it shocks me that you know, with, you know, interest rates now for 6-9 months way over 2%, that no one said, just a minute, we haven't tested these banks for interest rate risk. And that's a failure, I think, again, from the top down at the Federal Reserve and on the local scene. I mean, we now get information, for instance, that Silicon Valley Bank had a lot of warnings. There was a New York Times article today about that, and others in the San Francisco Fed knew there was mismatch. And again, they didn't go in and manage it or think that that could also be a problem with other banks and could cause a systemic problem through the banking system. I think this is another black mark on Jay Powell. As you know, he has not been my idol, to say the least, for many years. But, you know, this is a very serious oversight.
So then what we've seen with the banking failures just reinforces that path that you have talked about, that it's time to stop with the rate increases, just shut them down now and see how everything kind of reacts.
Absolutely. Now, you know, if you want to be honest, I think I come down on that they're going to go a quarter point. What's going to be more important, whether they go a quarter or none, is the guidance that they give later. And I don't just mean the dot plot. I think the tone of the press conference that Powell runs afterwards, because you can be sure that 99% of the questions are going to be about banking. You know, I don't know when these dot plot questions to the bank presidents were actually sent out. They may have been either before SVB or in the early stages, whether they're all going to get a chance to revise it or to think about it seriously. But I think the tone of what Powell says afterwards, I think he's going to say, my feeling is that if they do go a quarter, that's my guess, but it's a close one, that he will be saying we can afford to pause. The inflation data, Dan, has been coming out fairly good actually recently. As you know, producer prices came in way under expectations. We had a little bit of a loosening of the labor market with that February report. We had good University of Michigan inflation expectations report. So we can now say, you know, we're getting enough evidence that with the cumulative effect of monetary policy, we could afford to pause and wait developments. He will never commit a pause. You know, because developments can always change. And I've been one that is always saying, if you want to know the truth, they only make their decision probably 5 days before, actually. But I think that he will give the tenor of a pause at this point and see what direction, if the normalization goes, if the inflation goes down, you know, then they will set the course. I do expect that we will be lowering the Fed funds rate through the second half of this year.
That was going to be my next question to you, because that seemingly, in talking with a couple of other economists, is that is starting to become more in their mindset, that if they do raise a quarter point at this time, this may be the last one, and we could be talking about an actual rate decrease later this year, which obviously I think some people believed that maybe 2023 we weren't going to see that at all, but obviously that was well before what we've seen with the last 2 weeks with the banks.
You know, Dan, I kept on saying, when they kept on saying, everyone was repeating the mantra, you know, higher for longer, tighter for longer, and I said, hey, you guys, you don't know what's going to happen longer term.
Yeah.
And now we don't hear that. We don't hear that anymore. I mean, you really can change. I mean, most experts think the tightening in the lending standards and the chill that this produced is equivalent in itself to 2 or 3 25 basis point rate hikes. So, you know, clearly you don't want to pile on top of that. And you have to take that into account. I remember at the very beginning, you know, at the end of last year, when I really saw things going downward, I said, you know, we might have a 2 handle on the Fed funds rate by the end of this year. Everyone was laughing at me. And by the way, the data, still the real data has still shown good strength. But I wonder whether, you know, I really wonder whether we're going to see the turn, just the chill in the air, the caution that this sort of thing just brings about to consumers, producers, and really any borrowers.
Does UBS Credit Suisse play a role in that thought process, either short term or moving forward, because of obviously the connection here in the United States?
Well, I think that what happened to UBS Credit Suisse has had, in contrast to Silicon Valley, Credit Suisse has had problems for years.
Yeah.
And it's been going down, and you know, everyone was kind of wondering, and this kind of crisis sort of pushed it over, absorbing it into UBS, a big bank. They didn't wipe out the shareholders, but you know, shareholders taken a huge hit. It's an interesting case where shareholders may have taken only a 99%, and I think some of the bondholders, or certainly not the senior bondholders, the lesser bondholders, got wiped out 100%, which is a rare sort of a case. But if you want to know the truth, I think of a big bank I mean, that if that would happen, and I don't expect it to happen in the United States, the Fed would do the same thing. I mean, basically, with the central banks, I mean, certainly there's a difference. And we could talk about, but they both have the philosophy: you cannot allow a large bank to fail. You have to merge it in the other, and you have to, you have to prevent a bank run. Everyone has learned the lessons really of the 1930s, which of course produced the bank support in the great financial crisis, which was going to turn into the 1930s had not bold action been taken by Ben Bernanke at that time. But they've learned the lesson that you can't let this fester and then snowball into a crisis.
Jeremy, as always, great to talk with you. Thanks very much. All the best.
Thank you, Dan.
Thank you. Jeremy Siegel, Professor Emeritus of Finance here at the Wharton School.